ITT Inc. just completely crushed consensus for their second quarter. I mean, they posted a massive beat and raise. Revenue hit a record $1.47 billion. But interestingly, GAAP EPS actually missed, dropping about 37% down to 95 cents.
Right.
But if you look at their adjusted EPS, it came in at $2.08, which comfortably beat the 1.92 consensus. Plus, they raised their full-year guidance so high that the new low end is actually higher than their old top end.
Yeah, and the stock market absolutely loved it. I mean, the stock jumped over 9% before the market even opened. It hit intraday all-time highs near $230 a share. Just an explosive reaction.
It really was. And to figure out exactly how they pulled this off, while, in the middle of digesting a $4.8 billion mega deal, we are pulling from a stack of sources today.
We've got ITT's official Q2 earnings call transcripts, their SEC filings, and the latest equity research analysis.
Yeah, and our mission here for this deep dive is to really understand that dichotomy in the headline numbers. Because seeing official on-paper profits shrink by nearly 40% is usually a massive red flag for you as a retail investor, right?
Absolutely. But to really wrap your head around that stock surge, you have to untangle those raw numbers. Wall Street completely ignored that steep drop in official profits.
Which is wild. Like, how does a stock surge that much when the bottom line looks that messy? But I guess on the top line, the growth is just undeniable. That $1.47 billion in revenue is a 51.5% jump year over year.
Exactly. But that standard accounting profit, the GAAP earnings per share falling to 95 cents, that trips a lot of people up.
It reminds me of like buying a massive new house. If you look at your personal balance sheet on closing day, your net worth looks incredibly messy. You've got closing costs, inspection fees, the movers you had to hire.
Right, yeah.
On paper, you took a massive hit. But your actual earning power at your job hasn't changed at all. In fact, you just upgraded your life and your future equity.
That is the perfect way to look at it. The messiness in ITT's standard accounting numbers operates on that exact same logic. The market fully anticipated that official profit drop because it was entirely driven by that $4.775 billion acquisition of SPX FLOW.
Right, that deal they closed back in March of 2026.
Exactly. When a corporation executes a mega deal of that size, the accounting rules force them to record a lot of immediate upfront pain. The sources show ITT took a $62.6 million hit just in non-cash intangible asset amortization.
Wow.
Yeah, and that's alongside heavy one-time transaction and integration costs.
Let's translate that non-cash amortization into plain English for a second. That basically means ITT acquired things like patents, brand value, customer lists from SPX FLOW.
Right.
And the accountants basically force ITT to pretend those invisible assets are slowly losing value every single quarter, which creates this massive expense on the income statement.
Yeah.
But no actual cash is leaving ITT's bank account. It's just a paper loss.
Which is the critical distinction for anyone trying to value the company. Analysts immediately strip out that artificial paper loss and focus on the adjusted earnings per share.
The actual underlying health of the business.
Exactly. The adjusted metric filters out all that acquisition noise, the amortization, the banking fees, the inventory adjustments. And when you look at that adjusted EPS, like you said, it came in at $2.08.
Beating the 1.92 consensus.
Right. But more importantly, it represents 18.2% actual operational growth compared to last year.
And the profit margins tell the exact same story, don't they?
They do. If you look at their standard operating margin, it shrank by nearly 6 percentage points, dropping to 12.2%. But again, that's just the heavy gravity of the closing costs.
Right, the paperwork dragging it down.
Exactly. If you strip away the paperwork and look at the adjusted operating margin, it actually expanded to 20%. They generated $295 million in adjusted operating income, which is a 55% surge.
So for you as an investor listening to this is a textbook lesson in corporate evaluation. When a company undergoes a massive portfolio transformation, distinguishing between the temporary accounting noise and, the actual health of the factory floor is the only way to spot true value.
Yeah, standard numbers showed the painful receipt for buying SPX FLOW, but the adjusted numbers showed the sheer horsepower of the new combined engine.
And that engine is generating serious liquidity, too. Net cash from operating activities was up over 24% to $191 million.
Yeah, and free cash flow hit $162 million for the quarter. They are maintaining a very healthy 11% margin there.
Which means they are swallowing this massive acquisition while keeping plenty of cash on hand.
Right. So now that we've established that the SPX FLOW deal is distorting those headline numbers, we really have to look under the hood. We need to see how the actual integration of this new business is going on the ground.
And here's where I want to push back a little bit on that market optimism. Because in the real world, digesting a nearly $4.8 billion acquisition usually causes major corporate indigestion, right? I mean, it drains management's focus, it creates culture clashes, it disrupts supply chains when you merge IT systems. Corporate history is just littered with mega deals that destroyed shareholder value. So why is ITT absorbing this massive new entity so seamlessly?
Well, the operational data from the earnings call points to synergies materializing way faster than the standard M&A timeline. The market was bracing for friction, but ITT is delivering immediate revenue wins.
Like where? Give me an example.
Chase, our Flow Technologies segment, management highlighted specific cross-selling successes in the biopharma space, particularly out of their Lancaster team.
Okay, let's visualize what cross-selling actually means on the ground for a second. It basically means an ITT sales rep is already sitting in the procurement office of a massive pharmaceutical company selling them legacy ITT valves. And now, because of the acquisition, that exact same sales rep can flip to the next page in their catalog and sell them a highly specialized SPX FLOW pump on the exact same purchase order.
Exactly. You don't need to hire a whole new sales team. You just gave your existing team more tools to capture a larger share of that client's budget.
Which is incredibly efficient.
Yeah, and they also drove 9% order growth in their nutrition and health applications, which was heavily supported by strong systems orders over in Europe. And CEO Luca Savi, he specifically called out his recent site visits in the transcript.
What did he find?
Well, he spent time at an SPX FLOW plant in Italy, and he described it as a well-run 5S facility.
Ah, okay. For those of you not living and breathing manufacturing operations, 5S is a lean manufacturing methodology. It stands for sort, set in order, shine, standardize, and sustain.
Right.
On a factory floor, it means there is zero waste. There's literally tape on the floor showing exactly where the forklift parks. Every tool has a shadow board, so you know immediately if it's missing.
It eliminates all those wasted seconds of a worker walking across the room to find a wrench.
Exactly. So the fact that the CEO is highlighting the 5S status of an acquired plant means they bought a business that already shares their obsession with operational efficiency.
Yeah, they speak the same language. Savi also highlighted his time at their Shidu factory in China. He noted the untapped potential to grow faster in the APAC region by adopting a more localized entrepreneurial mindset rather than just dictating every move from headquarters.
So management isn't just watching spreadsheets in an office somewhere.
No, they are evaluating continuous improvement opportunities on the factory floor globally. But honestly, the most impressive metric regarding this mega deal integration is actually on the balance sheet.
You're talking about the deleveraging pace, right?
I am. ITT paid down $124 million in debt this quarter alone. That brought their leverage ratio down to 2.5 times, which hits their target a full 6 months ahead of schedule.
Which is huge. Let's contextualize why that matters so much right now. We're looking at a 2026 macro environment where the cost of capital, the interest rates companies pay to borrow, is a massive burden.
Yeah, carrying billions in debt from an acquisition is incredibly expensive.
Right. Every single dollar of debt they pay down quickly translates to less interest expense next quarter, which flows directly into higher earnings per share. Rapidly de-risking the balance sheet just proves the cash-generative power of this newly combined platform.
It's undeniably impressive how smoothly they are integrating SPX FLOW. But evaluating the new acquisition really only gives us half the story.
Right.
To get a comprehensive picture, we have to look at how ITT's legacy businesses are performing in the background. Because often, when executives are distracted by a shiny new acquisition, the core business starts to slip.
But the sources show the complete opposite happening here. It's not just the expensive new star player scoring all the points. The original team is quietly having a record-breaking season.
Yeah, the underlying business delivered 12.7% organic revenue growth.
That is wild. That means completely stripping out the billions they bought with SPX FLOW, the legacy company is still growing at a double-digit rate.
Exactly. And the standout driver of that organic growth is the Connecting Control Technologies segment, or CCT. They reported record-adjusted operating margins of 21.7%, and they achieved this while absorbing a recent bolt-on acquisition called Caseria.
The numbers coming out of Caesarea are just staggering. Orders for that specific unit surged an unbelievable 168%.
Yeah.
The sources show they are winning large mission-critical defense contracts components for advanced night vision applications and fighter jet programs. They've grown their backlog by 180% since ITT acquired them. That gives them defense program revenue visibility all the way into late 2028.
It really illustrates the immense power of a well-executed bolt-on acquisition strategy. You find a relatively small, highly specialized company like Caesarea in defense or Svanehøj, which they acquired for marine energy transition pumps.
Right, handling LNG and ammonia.
Exactly. These smaller companies have incredible technology, but often lack global distribution. You buy them, plug their tech into ITT's massive global sales and manufacturing engine, and you just watch the growth explode.
And that growth mechanics leads to something analysts call multiple compression, right?
Yes, exactly.
Huh?
Management noted they bought Caesarea at a 13 times valuation multiple, but they expect that to drop to an 11 times multiple by the end of the year.
Wow.
And for Svanehøj, they're projecting 32% average annual revenue growth, driving its acquisition multiple down from 13 times to just 6 times.
Think of it like buying a wildly expensive, state-of-the-art, energy-efficient refrigerator. The upfront purchase price, the multiple, is painfully high. But because it drastically lowers your electricity bill every single month, the effective cost of owning that fridge drops rapidly over time.
That's exactly how it works. ITT is buying expensive, high-quality companies and then growing them so fast that the purchase price ends up looking like a bargain in retrospect.
Okay, so the CCT segment and those bolt-on acquisitions are clearly thriving. But any objective analysis requires us to look at the weak spots.
Right. We have to look at the Motion Technologies segment, or MT. It paints a slightly different picture. They only grew 2% organically this quarter.
Just 2%.
Yeah. And the equity research highlights that this specific division is actively struggling with persistent raw material cost inflation. They just haven't been able to fully offset those rising input costs by raising prices on their customers.
Well, the global automotive market, which MT heavily supplies with friction materials and brake pads, is an incredibly tough environment right now. We are seeing slowing vehicle production globally.
Exactly.
So you have input costs rising, but you can't force your auto customers to pay more because their own sales are sluggish.
Right. But facing that dynamic, a 2% organic growth rate actually shows remarkable resilience. Despite the inflation headwinds in a down auto market, MT managed to outperform global vehicle production by over 3 percentage points. Yeah, and more importantly, they still managed to expand their operating margins to 21.1%.
Wait, how do you expand your profit margins when your costs are rising and your customers won't let you raise prices?
Through relentless net factory productivity gains. If you can't change the price of the raw steel or the final brake pad, the only variable you control is how efficiently you turn that steel into a brake pad.
Ah,
They are automating lines, they're reducing scrap material, and they're increasing throughput speed. Their baseline resilience and obsession with factory efficiency allows them to basically grind out margin expansion and steal market share, particularly in Europe and China, even when the macro pricing environment is terrible.
so the legacy engine is highly resilient, and the SPX FLOW integration is way ahead of schedule. But given the stock's massive pre-market pop and its run-up to record all-time highs near $230, the market is pricing in a lot of optimism.
A lot of perfection, really.
Exactly. We need to step back from the hype and examine the bear case. What are the cautious analysts pointing to in these sources? Like, what could actually trip ITT up in the second half of 2026?
Well, the sources outline a few structural and cyclical risks that require close monitoring. The first vulnerability showed up in the legacy flow technologies business. While total revenue for that segment was up strongly because they were shipping out past orders, their organic new orders actually declined by 3% compared to last year.
Wait, why are new orders shrinking in a segment that is supposedly booming?
The drag was primarily driven by delayed energy transition project releases in the Middle East. When you are dealing with massive multi-million-dollar infrastructure projects like large-scale water treatment or energy transition facilities, the capital expenditure approvals can get tied up in political or bureaucratic delays.
So they didn't lose the contracts to competitors.
No, management was very clear that these Middle East orders are delayed, not canceled or lost. But it does introduce near-term uncertainty into their pipeline. They're also facing tough comparisons against massive oil and gas bookings they secured in the prior year, making the year-over-year growth look artificially weak.
Okay, Beyond those delayed projects, the equity analysts also pointed out a pretty bizarre structural headwind coming up later this year, right? The fourth quarter of fiscal 2026 actually contains 4 fewer operating days than the fourth quarter of 2025.
Yeah, it sounds like a minor calendar quirk, but in industrial manufacturing, losing 4 days of production is a massive deal.
Oh, absolutely.
A typical quarter has roughly 60 to 65 operating weekdays. Losing 4 of those days means you lose roughly 6% of your available time to manufacture and ship products.
And your fixed overhead costs like factory leases and salaried employee pay remain exactly the same.
Exactly. It creates a pretty tough mathematical headwind for year-over-year organic growth comparisons in the second half of the year. Management was very upfront about this, warning that the growth comparisons get much harder in Q3 and Q4.
And then there is the overarching valuation risk. The market is pricing this company for absolute perfection right now. Following the post-earnings rally, ITT is trading at a premium forward price-to-earnings ratio of approximately 24.5 times.
That sits significantly above their traditional industrial machinery peers. When a stock trades at a multiple that high, there is zero room for error.
Right.
If the SPX FLOW cost synergies start to bog down in bureaucracy, or if the motion technology segment can no longer outrun inflation with factory efficiency, or if those delayed Middle East orders just vanish, the market will not be forgiving. A premium valuation demands flawless execution quarter after quarter.
But here's the thing. Despite those very valid risks, the Middle East delays, the missing production days in Q4, the premium valuation Wall Street analysts still rushed to upgrade their price targets after this report.
They did.
Citigroup raised their target to $267. KeyBank went to $263. Stiefel bumped their target to $265. Why are they ignoring the risks?
It brings us to the ultimate catalyst for the stock's massive jump. The 9+% pre-market pop wasn't just a reward for a solid Q2. The stock market is a forward-looking mechanism. The violent upward reaction was entirely driven by management's bold claims about the rest of 2026.
Right, the forward guidance.
Yes. The revised forward guidance was the defining moment of the entire earnings release. Management didn't just tweak the edges of their projections, they forced Wall Street to completely re-rate the trajectory of the entire business.
Let's break down exactly what they changed. They bumped projected organic revenue growth to a range of 5 to 8%, up from their previous estimate of 4 to 6%.
Which signals extreme confidence in their ability to continue taking market share, particularly in defense and aerospace.
But the ultimate flex, the number that actually moved the stock, was the adjusted EPS guidance.
They raised their full-year adjusted EPS target to a new range of $8.12 to $8.32. The previous midpoint of their guidance was sitting around $7.85. The new midpoint is $8.22.
That's a massive jump.
In the world of industrial manufacturing, a 37-cent upward to your earnings projection halfway through the year is a massive statement of confidence.
And this is the most crucial detail from the entire earnings call transcript. Interim CFO Mike Savinelli pointed out that the absolute low end of their new guidance range, that $8.12 figure, is actually higher than the absolute top end of their old guidance range, which was $8 flat.
Right. When a management team does that, it removes all ambiguity for the market. It forces institutional investors and sell-side analysts to completely redraw their financial models.
Yeah, think about the mechanics of how a stock price is determined by the big banks. Analysts build these massive Excel spreadsheets projecting future cash flows.
Yeah.
The pre-earnings Wall Street consensus for ITT's full year was sitting around $7.92. When ITT comes out and declares, our absolute worst-case scenario is now $8.12, analysts have to go into those spreadsheets and physically change the baseline inputs.
Which mechanically spits out a higher price target at the bottom of the spreadsheet. And when a bank raises its price target, it triggers algorithmic and institutional buying across the market.
That is the actual mechanical engine behind a stock jumping over 9% before the market even opens.
They also backed up those earnings claims with cold, hard cash flow guidance. They raised their free cash flow target to a midpoint of $565 million, maintaining a very healthy 10 to 11% margin.
Which confirms to the market that the paper earnings growth is translating directly into actual cash in the bank, right?
Exactly, which fuels further debt reduction and gives them the dry powder for future bolt-on acquisitions.
So, what does this all mean for you as you watch the industrial sector evolve? ITT is currently executing a masterclass in corporate portfolio transformation. They are successfully balancing the incredibly complex integration of a $4.8 billion acquisition in SPX FLOW without taking their eye off the ball.
Right.
They are simultaneously driving double-digit organic growth in their legacy businesses. They are finding massive success with strategic bolt-on wins like Caesarea in defense and Svanahurj in marine energy, and they are generating enough free cash flow to rapidly deleverage their balance sheet in a high-interest rate environment.
They are systematically upgrading the quality, the margin profile, and the resilience of their entire earnings base.
Which leaves you with this provocative thought to ponder as we wrap up.
Huh.
ITT is clearly transitioning into a higher growth, higher margin business. But as they expand aggressively into the marine energy transition with highly engineered LNG and ammonia solutions, and as they secure defense program visibility through 2028 with advanced aerospace and night vision components, are they still just a traditional industrial manufacturer? Or are they quietly evolving into a pure play advanced technology firm that just happens to be masquerading in an industrial wrapper?
That is the million-dollar question.
Yeah.
And if the broader market officially starts viewing them as a technology company rather than a heavy industrial firm, they will start comparing ITT to tech multiples. What happens to their valuation next if they are no longer judged against other machinery companies?
Going back to our opening analogy, the standard accounting rules made the Q2 numbers look like a messy, expensive closing day on a new house. But when you look past the immediate paperwork, ITT didn't just buy a new property, they completely transformed the foundation of their entire business. Keep a close eye on those Q3 numbers later this year to see if they can navigate that calendar quirk and maintain this relentless pace of execution. Make sure to follow the show for daily earnings coverage and deep dives just like this one.